This is another Two Graybeards explainer. And today's topic is going to be about how to judge a portfolio in terms of whether it's a attractive return stream or not. And I'm just going to use very basic concepts of risk and reward to describe what I mean by that. And I think the first thing to start with is that I wrote a thread on my Damp Spring site, and I recommend you take a look at that because, and I'll include it with any links to this video. The bottom line is that traditional ways, including the ways I will show you today, of evaluating portfolio depend on the back history, the so-called track record of a portfolio. And to be honest, they're just not statistically significant. If you look at any sort of longer term investment strategy, you're talking about a handful of years of performance. And most of the performance is probably luck, not skill. And these techniques are flawed in that way, in that you can't determine whether the person underperformed or outperformed based on just luck. For instance, if you take 1,000 portfolio managers and see how they do over 10 years and assume that they are just flipping coins with a 50-50 odds, one of them is going to have 10 years of perfect outperformance. But about 100, I think the number is 172 of them are going to have outperformance more than 7 times a year over that 10-year period. And so if you look at a bunch of people and you say, geez, let's look at 1,000 portfolio managers, and you see that, and you then narrow it down and you find the 100 and maybe there are 200 that outperformed more than 7 years in a row, 7 or more years in a row. 172 of them might have just had good luck. And so and you don't know which ones those are. So track records are not a great way of evaluating a portfolio, but I thought I'd explain some of the techniques you're likely to commonly see. And so for that, I'm going to share my screen. And remember, I'm talking about a portfolio, looking at history, and in particular, looking at short history or any history is not right. But nonetheless, here's a couple of portfolios. And I'm going to start with the one you may be familiar with, which is the Two Graybeards portfolio. And it's only been around for a year. Of course, there's no track record. Even if it was 10 years, there'd be no track record. But in explaining how the portfolio works, I'm going to unearth some questions that you might ask of portfolio managers who want to manage your money. And so let's start with what has happened over the course of the year. And so the Two Graybeards portfolio, the one in green, has underperformed all of these other portfolios over the course of the year. Does that mean it's a bad portfolio? It made 7-ish% return on your money from its inception. It was never down. It was pretty consistently growing from left to right, those are attractive things. And I'll go into more details on that. To describe the other portfolios, these are all 60-40 portfolios. One is the SPY, the S&P 500, with a medium-term bond fund called the IEF ETF. The other is the red line is the SPY with the TLT portfolio, which is a longer-term bond ETF. And you can see that one, it did okay and was a little more volatile, bigger peaks. But then it really had a drawdown when both equities and TLT fell from July, where we told you asset prices are likely to fall, to Halloween, where we told you to buy all assets. So that portfolio was extremely volatile. And then these two the blue and purple portfolio, the blue portfolio is the SPY 60% with 40% BND, which is the Barclays aggregate bond portfolio. So it includes a lot of corporate bonds as well as government bonds. And corporate bonds have outperformed. They're shorter duration, meaning they have less bond sensitivity like the IEF, and they have credit spreads like equities. That's been the best total return investment. Okay, so I said a bunch of things. I mentioned drawdowns. I mentioned volatility, which is the up and down that you deal with every day. And I mentioned total return. And each of those things are important. In particular, when you are making an investment, you're looking at the risk versus the return you get. And so if you look at this chart, you can see the green line. And again, this is a short track record. We're not talking about whether you should make an investment decision based on any of these things. We're just talking about what to look at when you look at a track record. You can see the green line is underperformed for most of the year, but was extremely low volatility and had only a slight drawdown. We have a minimum equity threshold. We won't allow our portfolio to go below 20% equity. And that was the root cause of most of this drawdown that we did experience between July 31st and Halloween. But other portfolios had big peaks, big drawdowns. And I want you to think about what that's like. And this is the important concept in this discussion, is what is it like to have a volatile portfolio? You have a portfolio that changes all the time. And so if you're the type that, let me just turn these notifications off. If you're the type that has a portfolio that looks at their portfolio often, it may stress you out if you have a portfolio that moves around a lot. Now, you're going to be happy. You're going to feel great when it goes up. You're going to feel awful when it goes down. And so all along, you're seeing this volatility, which creates stress for you as an investor. And how do I mean by that? If at any point in time you decide you don't like the swings and you close your investment and go to cash, you no longer get your return. And so the most important thing as an investor is to be able to withstand the risk that your portfolio has. And so you have to decide how much risk you're willing to take. And the next most important thing is for you to get a return that is commensurate with the amount of risk you're taking, so that you optimize your risk adjusted return. You know what your risk is by what you can live with. And as I mentioned, that's a combination of the daily swings or the weekly swings, or however often you look at your statement swings, and the drawdowns. And so the drawdowns are a very important factor, because if you felt so good, or you started spending some of your gains in anticipation of these portfolios continuing to perform, and you borrowed money on your credit card, whatever you did that caused you to tap into this savings. You didn't sell anything. You just said, okay, I'll spend some of my other money on whatever. Then you have this drawdown and you're like, oh my God, this is a disaster for me. Markets have fallen 15% from here to here. I need out. And of course, then you miss these up returns. And so both daily volatility and drawdowns are important metrics for portfolios. Now, I mentioned the concept of allocating risk to your portfolio, and that should define your thinking. How big your drawdowns can be that you'll sleep, and what your daily, weekly, monthly, whatever volatility measure you're talking about can make you not worry about your portfolio. Once you have that set, then you can determine, okay, this portfolio, this red portfolio, is clearly a lot more volatile. So if I want to buy that portfolio, I have to keep a lot of cash on the sidelines because I don't want to have my overall portfolio lose a lot of money. On the other hand, if you have this green portfolio, which is the two graybeards portfolio, you have, and again, I want to caution everyone, this is 1 year. This is not a track record. Okay. And even if it was a track records are mostly useless. But conceptually, if you have a portfolio that has low volatility, you can borrow money and lever it. But regardless of that, you're trying to target a volatility that you can live with, and then you're deciding how much cash on the sidelines or margin you want to use to invest. And so how do you look at that? So one way is to look at Sharpe ratio, which is the ratio of the return on the portfolio that you expect divided by the risk that you expect. And so if you neutralize each of these lines by their Sharpe ratio, or better yet, by their volatility, so that each line has the same volatility as the other, this is how those returns look. Notice that the green line, which had the lowest volatility, outperforms in that circumstance. And so what I did is I used this blue line and said, this is from the prior, which was the best performing line. It earned 10.4%. And I just brought it over here and said, okay, that's the blue line. It's going to earn 10.4%. And I scaled up the holdings of this line. I scaled down the holdings of this line because it was much more volatile. And you can see that on a risk-adjusted basis, this line did the best. Now, that's just using volatility as a risk measure. And you can see even the drawdowns, the green line now has bigger drawdowns than it used to. And again, this relatively large drawdown of 10%, if you lever up two graybeards, is because we were 20% minimum equities regardless. The overall pattern of drawdowns is still attractive relative to all the other investments. So on two metrics, both the daily volatility and the drawdown, the two graybeards portfolio looks more attractive on a risk-adjusted return basis. And that's what I'm looking for. And again, using long-term track records still doesn't get you very far because portfolio managers change, styles change, things change over long periods of time, and they're still not statistically significant and could be mostly luck. But nonetheless, you do conceptually want to own a portfolio that has the highest risk-adjusted return. So let's look at this idea of, so I mentioned that this is weighting the portfolios by volatility. Let's look at the drawdowns. So what is a drawdown? That means that at some point your portfolio is worth less than it was in a period of a prior time. And so when you have a drawdown, you're like, geez, do I want to stick with this investment? That's a very typical decision that people think about is, gosh, it may come back, but is it any good? I've lost money from my peak. Do I want to own this thing anymore? And so you want to find a portfolio that doesn't put you in that position of feeling those feelings such that you then make an investment decision based on your emotions. And drawdowns have a significant impact on emotions. If you look at the two graybeards portfolio, our worst drawdown from peak is 4%. And we're now at peak, which is good. But there have been periods of 2-ish% drawdowns in the past. And to me, that's a very low level of drawdowns, one I hardly would notice, frankly. On the other hand, if you look at the TLT portfolio, the 60-40 portfolio where bonds are the long-term bonds, That still is in drawdown. Going back to this table, the peak return on TLT was right before that July QRA, and it's a long way off returning to that peak. And so you're still experiencing the, should I hold out on this thing such that I can get my money back and or dump it? And so you're still experiencing quite significant emotions regarding whether the 60-40 portfolio is a sensible one to hold. And so we think it's better to have a portfolio that has lower drawdowns. So let's look at that all in a table form. Here we have two gray beards. When you think about returns, you have to think about in excess of cash, because your alternative is just to hold cash. And you can see it actually had the lowest return. We just started, we definitely missed the AI phenomenon. It's generating a 4% return in excess of cash, and it has the lowest volatility, annual volatility, and the lowest drawdown by a long shot. So it's a portfolio designed to earn you money and keep your wealth. Now, SPY versus TLT, as I showed you, is still suffering from long-term bond yields rising. And SPY versus bond, which is again a portfolio that is the aggregate, all bonds, including corporate bonds, etc. And you can see that performed the best, because it actually has a pretty sizable amount of corporates, which make it have a pro-growth bent to it. And so corporate spreads have done very well as equities have rallied, et cetera. So it really had more than 60 equity. It had 60 equity plus some equity in some corporate exposure. But it did very well. And it had a great Sharpe ratio. This is a solid Sharpe ratio. Again, it's less than a year of performance, but that one seemed to have performed the best from a risk-adjusted return basis. But it did have a big drawdown. And so you have to judge, okay, now this is the balancing act. This portfolio had a superior absolute return, a superior risk-adjusted return, but a large drawdown relative to this one. And so you have to judge, would I be willing to, if I use a metric of volatility, I could double, about a little less than double the size of the portfolio of the two graybeards portfolio leverage and generate about the same return. Or if I used drawdown as my metric, perhaps I could more than double and thus earn more than the SPY BND portfolio. So again, it's just a matter of what your level of risk is. If your level of risk is you're only willing to accept a 4% drawdown and a 5% annualized daily volatility, you have to own cash in each of these things. At least 40% cash, and possibly as much as 60% cash. And so if you do that, you don't get these returns. So the point being, you want to target your portfolio's forward volatility. How do you figure out what its forward volatility is? You understand how it's constructed. You understand what the portfolio manager is trying to do. And you compare that to whether they did it in the back history, but don't have a hell of a lot of confidence in the back history. Anyway, you can do that, and you can do it versus the drawdown. And when you pick those two things, you capture, there's a lot other risks in life, but you capture a significant portion of the risk-adjusted return and your target and what it will feel like to own an investment. That's all I have for today. Again, take a look at the thread I included that goes into a bit more detail. And again, don't use past performance as future predictors. Try to understand what the portfolio manager is doing, and take a look at our videos on Two Graybeards YouTube and at twograybeards.com. Thanks for listening.